Okay, so we left it last time at we finished filling up the data and we were just starting to consider some valuation questions on this, right? Do you want to maybe recap what the company does just quickly?
So Energy Pro was the hypothetical company we came up with through ChatGPT, and basically it's a UK-based SaaS company that provides tiers of energy monitoring services to corporations, so monitoring or analytics, maybe predictive as well, on a SaaS basis, so recurring revenue with some large contracts as well.
Yeah, indeed. And now it's raising £1 million to expand, if I'm not mistaken. We wanted to get a very strong foothold in the UK market. I remember we didn't include international expansion in the projections, right?
Correct. Yeah. Originally, we were looking at a 2 million euro raise, and that maybe would have covered some more ambitious expansion. But then we kind of pulled it back a slightly more conservative case.
Nice. Yeah. Now raising £1 million. So that's, I think, where we should start, right? So we said last time. So what we are trying to do here today, I think, is try to get this valuation as ready as possible for investors. And what we are trying to make sure is that the future strategy of the company and the future plan, future risk and return is as much as possible included into the valuation, and it's computed into the valuation. And then we go and present this valuation to some investors that are not our top selection, and we see what their feedback is. We can implement that feedback in the numbers and then really go for the investors we are interested in. One of the questions that we already went over is, okay, how much are we raising, right? And I think that remains a question right now. We saw some data yesterday, I think, from PitchBook, right, for the fundraising in Europe and how much the different rounds are. I think there was like the seed round now is currently around 1.4, right? If I'm not mistaken. So we are in that category in terms of rounds that we want to cover. But I think we should use the benchmarks to see what other startups are raising and at what valuations and so on. So given that, shall we give that a shot?
Yeah, sounds good.
So we should try United Kingdom. We already have revenue, right? So we are expansion and growth. We start narrow and we see if we have enough data.
We're only slightly outside of the startup stage. Do we want to include that too, maybe?
Yep.
Not like we have
see.
millions in revenue.
Yeah. My memory is very short, so we need to to look that up. But indeed, we are in business support services, because it's mostly B2B, right? If I remember.
Yeah, and under business support services, there was, I think the industry we selected was environmental services or other environmental services.
Yeah, but that's like super narrow. So if we do business support services, I think we are already. So what we do now is we investigate all our database in an anonymized way, and we investigate also Crunchbase to see whether there is enough data to have meaningful comparisons. And we get an alert here on small sample, meaning that we have some data enough to get a basic understanding, but it should be clear that is not a lot. And I clicked the wrong thing. So it wants me to use all the startup stages and use Europe. I would still try United Kingdom and just the startup stages, and see even if we have little data, and then we can make it broader from there if we desire by adding the rest of Europe.
Yeah, I suppose if you were going to be presenting this report to investors in Europe as well, then benchmarks across Europe would be relevant to them.
Yeah. And we see here we have 45 companies. These are all recent, so the past, I think, 3 years. And we have a bit more from Crunchbase, so we do have some data to play with. We see on the valuation side, so this, because they are not so many, like these are pretty, I would say, interesting to look at. We are on the upper bound of valuation. If you look at the median is probably somewhere here for Equidam, and then more like here for Crunchbase at this stage. So between the 1 and 4 million. So with our valuation at 9, we're definitely going out a bit further than the average.
Hmm.
In terms of fundraising, that's fine. Like in terms of amount, it looks like very much in line. But then because we have a higher valuation, we end up offering less equity than the median for the. So we're valuing Energy Pro. Also here we are. These are the 10 most recent funding rounds happened on Crunchbase with the same filters. And also here we are on the higher side of the current funding rounds, at least in terms of valuation and also in terms of capital raised. Okay.
And we said
And
this was like
then,
a something like a large seed round. So it's between like 15 to 25% dilution is the norm, like generally speaking as well.
yeah.
Should be thinking
And,
somewhere in there probably.
and we would get that if we raise the 2 million, right? So
Hmm.
that's also like if we were like probably, yeah, you see Crunchbase actually the majority at this stage raises 2 million likely.
Hmm.
So maybe our initial idea was more balanced. We give away more of the company, which is more in line with the market. We raise more money, which we need for expansion, and we are more in line with the current status of seed in the UK. So
Yeah.
uh, yeah, this one, to be honest, I don't remember what we said about this company compared to its competitors, but
We said started in 2021, 30 employees,
okay.
and the past year's revenue was 350,000.
Yeah. Okay. And then here we see, yeah, we have like a little bit more optimistic growth because of the future expansion as well. And then we have more optimistic EBITDA because we're not including a lot of those costs of expanding across Europe in our costs, which results in a higher valuation than the average. And also our margin is higher than the median, yielding a valuation that is higher than the median,
Hmm.
which is fine. We're okay, we are raising for R&D, whereas most people are raising for operations in this industry. So that's interesting.
But we have quite
Uh,
a lightweight operating model, I guess. Doesn't require a huge amount
yeah,
of expenditure.
yeah. I think when you include business support services, some of the companies will definitely have a more hands-on, like people approach to services,
Hmm.
whereas this company is purely software. But then I would say, okay, then it makes sense to think about a fundraise for 2 million, right? And then I would probably change that, or at least consider changing that if I was the company, at least for those first meetings, right?
Hmm.
What I also wanted to check was the multiple. So multiples, we just talked about making this video about multiples rather than making this video, but um,
All roads
so
lead to multiples.
yes, indeed, multiples for a company at this stage with this future, like in my opinion, they're gonna be discussed, but they're not gonna be sort of the center of the discussion with investors, just because it's not a commodity type of business, is not yet stable or so you see multiples really pushed when it comes to marketplaces or like more predictable SaaS type of things. So this is a
Hmm.
fairly predictable SaaS, but in a unique market, maybe, I don't know, I would try not to base the valuation on multiples. We talk a lot of times about how multiples at early stage don't make a lot of sense, and so yeah, but
Yeah,
still,
so maybe just to quickly reference one of the interesting Andreessen Horowitz articles about this specifically. The point that they make is the multiple is actually an output of the valuation rather than an input. So investors should be looking at the multiple you get as an outcome rather than trying to target investment based on a pre-existing multiple.
yeah, yeah, and we can take a look at that. So we have a module here in beta, but before that, I wanted to take a look at the valuations per se. So we do have the discounted cash flow with multiples being the highest one. And this depends on the multiple. So that's something that we can double check. So we are on environmental services, which shouldn't have a extremely high multiple.
Unlike
Uh,
software
uh,
or yeah.
yeah, yeah, exactly. Unlike software these days, and it has 14x EBITDA multiple. This is based on the industry that we selected, based on data from Professor Damodaran at NYU. what we could do quickly is just try to think about a couple of companies in a similar industry and just take a look at their multiples. We have here some like companies in the same industry that we select automatically, but it's just to show really some initial data here. For example, this one likely has a bit of like $1, and then the multiple becomes huge when you do valuation divided by EBITDA. So I would remove that. Yeah, we have a lot of environmental type of things. Renewy, interesting. I wonder like if there is a here is where I would do like a little bit of Google search and see what are the or ChatGPT search and see what are the public companies that are doing energy software, if there is anything.
Yeah,
Maybe
I've got a few
has
examples if you want to try them.
Nest. Yeah, sure.
So one is Schneider Electric.
All right. Ah, nice. So they're at 12.
Interesting.
Infrastructure. Yeah. So these are probably some secondary companies. Yeah. So these are at 12. Do you have other ones?
Johnson
Yeah.
Controls. That one seems a bit more relevant, a bit more specific.
Yeah. Nice. 15. 15. Okay, so just to get an initial idea that the multiple of 14 is not twice the market or anything like that, right? So I think we can be okay with that. I wouldn't use these advanced multiples. We would need to really find proper companies here to actually display them. But if I turn this off, we go back to the multiple of 14 on EBITDA, which is, it looks like it's fine.
Yeah, and it takes relatively little effort, especially with ChatGPT, to look for similar public companies and then look at
Yeah,
their multiple. It's a good way to preempt questions about the multiple from investors to do
indeed.
that research ahead of
Indeed.
time.
Yeah. The last thing that we should look at is like the reverse calculated multiple, which here, like from our current valuation and our current revenue, comes out at 113x, which is definitely more than 14x what we have. And like in this case, we are like well above the multiples of all industries when we look at the highest and lowest current multiples for each industry. And also, if we look at the historical for the renewal industry, environmental services and equipment, we're still like well above. But this is what I was saying before. This is a startup, right? It's still in that like incredibly high growth phase. Actually, like started 2021, now has 30 employees, like strong contracts, large profitability, and so on and so forth. So applying a multiple to that is not the most useful thing.
Yeah, a simple way to think about that is a startup that's just signed its first contract and made its first €1,000 in revenue. Like try and do a revenue multiple for that. It doesn't make any sense, but it makes
Yeah,
kind of progressively makes more sense. The older a company is, the more traction it has. So
yeah,
over time, it starts to make a bit more sense.
yeah, and that's the difference between the two multiples. So we were talking about 14. So 14 as a multiple on Equidam, we applied to the last year of projections. So in this case, to the fifth year here, and then this calculates a valuation. And then when we go try to calculate the implied multiple, that's the implied multiple today. But it wouldn't make sense to apply a multiple of 14 on today's revenue, because today's revenue is not even close to like a steady state of this company. One thing that I did see is that we didn't include taxes, and we should, because the company is profitable. So here, if I click this button, we're gonna estimate taxes based on the UK tax rate, so based on the country of the company. So just wanted to do that and then calculate the new valuation.
And
So just to explain what I just did, we actually have to calculate taxes forward, not backwards, because otherwise the model doesn't know what kind of taxes you paid before, and it's going to assume you pay them all afterwards. So in the end, this is the correct taxation. And it looked a bit high, even for the UK. It looked a bit high, the 1.8 million here. So this is much more correct. And now we changed it, and now we have a valuation of 8.2 for a 2 million investment that comes out at 20%. It's pretty nice.
Yeah.
Uh, Awesome. Yeah. Okay. I think we are good. Do you have any other questions? Do you think there's something else that we should touch upon?
Maybe the advanced settings might be worth a look just to see if there's
Yeah.
anything in there that a founder particularly might want to check out or that may be relevant to
Yeah.
investors.
Good point. Yeah. So advanced settings are where users of our platform can change any parameter of the valuation, right? Any parameter is open for change. And normally, like, you don't need to, but it's good to always take a look. If you want to change parameters, you activate the custom values here, and then you can change the weights of the methods to the extreme of deactivating some of the methods. And then you can change each of the parameters here. So yeah, people ask us, what would you put in here? And like, well, my answer is what we did put in there, right? Because if we had a better answer, we would actually put it in there ourselves. So normally there isn't much to change unless really the company is very peculiar. Maybe like infrastructure companies or like agricultural companies that have very, very long projections. They need to change some things, or maybe some investors are really only interested in seeing like the methods that they like or the methods that they know or something like that. But normally that shouldn't be the case. So yeah, I mean, everything looks okay to me here.
I think the most
Uh,
interesting part for investors perhaps could be the weights of the qualitative methods. So you might have a particular industry or a particular focus as an investor where you believe because of that focus the quality of the team is super important. It's way more important
yeah,
than the others. So you can come into here and up the percentage, the weight of that particular factor, and reduce the others a
yeah,
bit. So you can
yeah,
like
indeed.
codify your thesis a little bit.
Yeah, and I think on the other side, like the for investors and advisors and consultants that are very analytical on the discounted cash flow, what what we have that is kind of additional to the standard discounted cash flow is a couple of additional discounts. One is an illiquidity discount, which is also called a lack of marketability discount, just because the shares are not liquid, so they're a bit harder to sell, and they're gonna require a decrease in price, so a discount. And the other one that if you do the valuation of a public company or something a lot larger, you don't have to include, but you do when you're looking at a small company, a private company, is the probability of survival, right? So this is pretty interesting. So we don't add necessarily additional discounts because the company is private or small or risky, but we look at the specific survival probability coming from the average survival of companies from the same country in the same batch in terms of age, right? Um, but you can think about this as really as a probability of survival. And so as an investor also, you can see that, okay, this is the valuation based on a probability of survival of 50%. So this is not just the valuation of the best case scenario of the company. It's already a weighted average, in a sense, of a couple of scenarios, one of which is that the company doesn't make it at all.
Mm-hmm.
So yeah, and of course you can tweak this, and this becomes quite important when you have these very large bets that have very small probability of actually paying off. Like, say, for example, these days, a lot of AI seems to be like that. You can adjust here. So sometimes financial projections are really, really huge, and that's because the company wants to do that. They want to be that. But what you need to tweak in that case is the probability of success. This
Mm-hmm.
also is the case for movies and games and things like that, which can have a huge payoff, but the probability of that huge payoff is really smaller compared to a standard company, let's say. Hmm.
Interesting. Yeah, in both those cases, and in fact all of those cases, it's kind of like the more the more ambitious you are, the more you are going to spend on the project, the greater the chance of complete failure, but also the greater the chance of outlandish success.
Yeah, I don't know if it's linear, right? A lot of the times, like the chances of success, they raise with capital, but up to a point, and then like you raise too much, and then that actually decreases the chances of success. So,
Mm-hmm.
but yeah, it's a variable to be considered and to be analyzed as well. Um, yeah, but I think other than that, we are at this point we would be done. We can go generate our valuation report. We can include the benchmarks if we want. They are fairly good. We found enough data. We have like interesting data there, so we can generate a report. And this is I mean, one of the last steps of the process, right? We can use this to go talk to investors, to go send a counter offer to somebody. That's the goal of it, really.
Well, just to cover that part, maybe like when do you suggest that founders would share this with investors?
Yeah, well, normally what we say is a lot of founders think that they need to make a proposal, but you don't have to. You can let investors make that first proposal, at least as a range, investigate with questions like, have you seen similar companies to us in the market right now? What kind of valuations have you seen for those companies? Just to make sure that the valuation is aligned when you have one of those initial meetings.
Mm-hmm.
And then as you go along, try to to make sure that expectations are aligned on valuation. Otherwise you end up risking to waste a lot of time and also say no to other investors, and then end up with no offers. So the report is useful because of all this thinking, to empower you with the right numbers, with the right knowledge, to understand what is fair. We also get the feedback. There are some investors that naturally uh, don't do a fair valuation, maybe because they are emotionally involved. It's like it's your family or something like that. So you want to be fair with those investors. So you are looking for to calculate a fair valuation. Or otherwise, we see usage of the report also as a counter when it gets to that valuation negotiation, and you want to have some solid footing to stand on to make a counter offer. So that's where the report comes into play as well.
Yeah,
And we have a
certainly.
video. I don't. We have a video about like the report and all its pages, and we can link that in the description. So like you see what's in it.
Yeah, it's like the friends and family round. I think is a great example because it's a case where you obviously want to get both sides, you know, the same information, the same kind of opinion about the future of the company, aligned expectations, and then a really fair, as fair as possible valuation in terms of the deal and so on. And really, that should be true for every fundraising round you do.
Yeah,
But there are kind of adversarial forces later on with some investors. But in general, yeah,
yeah.
that idea of laying out all of your thinking, all of the logic to be examined, picked through, questioned, it's the best way to get to a consensus on this.
Yeah, it's the best effort, right? And especially when you're dealing with family, when you're dealing with friends, you want to do that best effort to try to be fair. And then of course valuation and just the future of the startup is so extremely uncertain that like it's not about reaching that precision. It's not about having the final valuation which is completely certain. It's more about giving it a fair shot in the time and with the knowledge that you have,
Mm-hmm.
and try to make sure that everybody has a fair deal. And that's what the platform can help with.
Nice.
Yeah, good. All right, I think maybe we stop it here for this one. We'll follow up with more videos on valuation of other types of business models. So we have already in our plan to do something like AI, something like deep tech, something more traditional, maybe like a shoe brand or something like that. So we'll do more of this one. So stay tuned, and we hope you like these videos.
Yeah, and if you have any specific requests, leave them in the comments below, and maybe we'll see how it works out.